In this video, I'm going to help you discover why and how to revamp the 1% rule for rental real estate to help you maximize your investing success. What's up YouTube? I'm Rob and this is the Cleveland Investor Primer channel, your resource for unbiased, comprehensive real estate investing information. If you're new to the channel, please consider subscribing and tapping that bell icon to get an alert each time I publish a new video to help you on your real estate investing journey. Unless you're totally new to real estate investing, by now you've probably heard of the 1% rule for rental real estate. But in case you haven't, I'll break it down for you now. The 1% rule basically just means that your expected gross monthly rent on a property will be at least 1% of the acquisition cost and any necessary work to get the property ready for a tenant. An example of this would be if you bought a house for, say, $110,000 and immediately put $10,000 into it for new paint, carpeting, a few other repairs, bringing your total to $120,000. To meet the 1% rule, you'd then need to rent this property for at least $1,200 per month. In 2019, you'll find that the 1% rule is seldom or never achievable in most coastal markets with high prices and high price to rent ratios, like San Francisco, New York City, Los Angeles. But it actually is quite achievable in many of the markets that investors are pursuing for cash flow. Markets like Memphis, Pittsburgh, and of course my favorite market, Cleveland. But with that, I feel it's my duty to offer some words of caution. Do not just apply the 1% rule blindly to all properties within a given market without first considering the caliber of the property's location all the way down to the specific census tract level. See, Cleveland, like any major metropolitan area, has a very wide range of grades throughout, ranging from A and A+ areas with high median incomes, well-educated residents, low vacancy rates, and pretty high rates of homeownership, all the way down to D and F grade areas with extremely low household incomes, low levels of education, high rates of vacancy, low rates of homeownership. Along with those highly varied grades by area comes a huge range of risk. The tenants who will typically be living in a grade A area will be vastly different from the tenants who will be typically living in a grade C area, and totally worlds apart from tenants who will be living in a D and F grade area. Basically, the further down the grade spectrum you go, the more costly and frequent turnovers will be, and the more likely you are to face problems like criminal activity, evictions, and even vandalism. So with such a wide range of risk associated with investment opportunities across the location grade spectrum, does it make sense to apply the same rule across the board? Of course not. And that's why it's time for a revamp of the 1% rule. While the 1% rule might be a decent rule of thumb when you're looking at properties in that A or even the upper tier of B grade range, once you get down to the C range, it's time to rethink and adjust that rule of thumb. For this reason, I believe that when you're evaluating properties in that C grade range, rather than using the 1% rule, you actually adjust it and start using the 2% rule instead, which would mean that the gross monthly rent should be at least 2% of the total acquisition cost. And then of course, once you get down to the D and F grade locations, the risk is that much higher still. I would advise you actually adjust to the 3% rule in that type of area, which of course means that the gross monthly rent should be at least 3% of the total acquisition cost. What I'm seeing quite often is investors who don't have tons of familiarity with the area, quite often they're out of town and just don't know the lay of the land. They'll see these numbers, these prices, these rents in a listing and plug those into a spreadsheet only to exclaim that they found the best possible deal ever and they're going to cash flow like mad. But they really just don't realize that they need to adjust those assumptions in their spreadsheets to account for higher turnover costs, higher maintenance costs, more drama in general. Ultimately making that cash flow that at first glance looks guaranteed, not quite all that it's cracked up to be. If you're not quite sure how to differentiate between the different grades of areas, you can check out the area guide on clevelandinvestorprimer.com, where I've posted a comprehensive data-driven map and corresponding report card that shows the grade for each sub-area within the Cleveland market. The grades were all calculated using publicly available data and really will get you the most accurate picture of the grade for each sub-area within Cleveland and its suburbs. If you'd like me to share the details and process of exactly how I went about creating this model, please let me know in the comments and I'll consider making a video about this in the future. As you continue along in your investment journey, if you keep in mind not just the 1% rule, but also the 2% rule and the 3% rule, and know when and how to use each, I believe you'll have even greater success in your investment endeavors. If you found this video helpful, please do click the like button down below and subscribe to the channel for more future content like this. Once again, this is the Cleveland Investor Primer channel. I'm Rob, and thanks so much for watching.